Signs of distress in the commercial real estate sector as very few lenders are now willing to provide financing. Our next guest expects this trend to continue and says that office values won't regain pre-pandemic levels until 2040. For more, let's bring in Kiran Raichura, Capital Economics Deputy Chief Property Economist. That's a very, very long road when you consider some of these developers and when those current mortgages, that debt's going to be due. What does that suggest in terms of the risk of default, which has really been hanging over the market?
Yeah, thanks for having me. It does suggest that we're going to see a large number of office properties handed back to lenders, and we're already starting to see some of that happening, both in terms of some specific loans where property owners have worked out that it doesn't make economic sense for them to hold on to those assets, and then they've handed those back to the banks, particularly in some of the hardest hit cities. And we're also seeing increasing distress amongst CMBS loans. So the office CMBS distress delinquency rate is now above 4%.
Kiran, when you take into account what happened in New York this week, the big deal, SL Green selling the 50% stake in one of its Grand Central buildings for $2 billion, does that add any sort of comfort just in terms of the fact that, hey, maybe it's not as weak of a position that we initially thought it was?
I think, there are always going to be some buyers out there. For assets to transact, there have to be buyers there. And we know that's what happens in a downturn. Activity slows, but there's still people who look to take those opportunities. But what I would say is that a lot of the assets that are transacting are doing so at substantial discounts to the values they would have transacted at previously. And so there are really good examples of buildings, particularly in the worst hit cities like San Francisco, that are transacting at between 50 and 70 or 80% less than what they were previously valued at some point prior to the pandemic.
So what brings that value back? I mean, I realize we're talking about 2040. That's a long way away, but you're saying we can get back to that level, right?
Yeah, it's actually very easy to see this take much longer than that. So actually, I've been recently looking at what happened following the GFC, and we had a peak in office values there at the end of 2007. And they literally only just regained those peaks by the end of 2019. So even then, that was a 12-year period. What we're expecting to see here is a much slower recovery because of the structural hit we're expecting to see because of the reduced use of office space. And so actually, it's very easy to see values take much longer to get back to those levels. And actually, the kind of growth rate we've assumed to get back to the peak after the size of the fall we're expecting over the next few years is higher than the rate we've seen in the last 10 or 20 years. So actually, it's quite possible to see that recovery take much longer than the 15 years that we've kind of penciled in, and it could be well into the mid-2040s even.
Well, Ken, that's a lot to digest because I think a lot of people are just scratching their heads whether or not we were ever going to get back to those value levels, but then saying that it could be well over 2 decades away, I think is obviously concerning in terms of the economic implications, what that could mean for the broader economy. But before we get there, just in terms of the office conversions, because we started to see that pick up just a bit, is that going to help cushion any of that blow?
It will help those assets where it's possible. One of the issues with converting office to multifamily, which is the kind of the most obvious use case that often gets held up, is that the kind of configuration of buildings isn't great for multifamily because you need to have access to light usually in a flat, in an apartment. So unless it's a very small floor plate, it doesn't really tend to work that well for conversion to multifamily. And the other thing as well is in a lot of cities, it's not really very easy to do so in terms of planning permissions. So I think we need to see more action from cities and city planners to actually enable that and, if anything, support that conversion to try and make sure there is still a constant flow of people and businesses in their CBDs.
Kiran, you mentioned a 4% delinquency rate right now. How much higher do you expect that to go up in the years ahead?
We don't specialize in the CMBS market, but it'd be quite possible to see that reach double digits by the end of this year. Certainly, the data comes from a company called TREP, and they on their podcast have been talking about double digit rate by the end of the year, and I think that's quite reasonable. We saw a much bigger spike than we've seen so far following the GFC. But it's much more of a slow burn this time because the way that offices are being, how the hit is playing out is much slower because it takes firms to vacate their space when they have either a lease expiry or by subletting that space. Whereas in the GFC, we had this period where firms just went bust and vacated that space immediately and the landlords stopped receiving rent. This time around, landlords are still receiving rent, but that rent roll is going to gradually reduce for the average building over the next few years.
Kiran, what about the rest of commercial real estate? You briefly mentioned multifamily there just a minute ago. What about industrial? What about retail? How is that faring in this environment?
So there's a general hit to values, which is coming from this increase in interest rates that we've seen over the last year or so. So if you think about the end of 2021, the 10-year Treasury was at 1.5%. It was about 3% by the end of last year. We're now kind of in the mid to late threes. And that has a bearing on how property is valued. And at the same time, we've also seen an increase in debt costs. So for those buyers who are using debt, that also has an impact in terms of how much they can pay for a specific property. So we're still expecting to see a hit to values in all sectors. So for apartments and industrial, we're around 22% peak to trough. But what I would say about those two sectors is that they have strong fundamentals in place. So for industrial, there's this long-term trend which is being supported by e-commerce growth. Mm-hmm. So we think there's a good medium and long-term story for that sector. There's just essentially a pricing correction happening right now to this new level of interest rates. And for multifamily, it's quite similar. In general, the US is fairly short of housing stock. And it's a sector that tends to do well also if we have inflation, which we already have had in recent times, because there tends to be a better link to earnings growth. So again, there we think the medium and longer term prospects are pretty good. Just in the short term, there's this supply overhang coming through because of a lot of new supply completing in the next couple of years. And then retail, the one which had been struggling the most previously, is the one where we think the prospects are actually best over kind of the next 1, 3, 5 year period, whatever you choose. So we've got around a 10% peak to trough fall in there from mid last year. And actually from next year, we think returns will probably turn positive for retail assets.
Yeah, so some positives to take away there, but a gloomy outlook for at least offices, no matter how you look at it. Kiran Raichura, Capital Economics Deputy Chief Property Economist. Good to talk to you today.